Good morning, class, and welcome to the Chapter 8 and 9 Instructor Review. Our first topic today will be total asset turnover, which is a ratio, and measures how well a company is doing with the assets they have to work with. For example, it really tries to answer the question, if you're given this many assets, how many dollars worth of sales can you generate? And higher is better. And here's an example of Starbucks and Ch8and9. So it looks like 2 years ago, 1 year ago, current year, it looks like the total asset turnover for Starbucks is going from 1.65, 1.60 to 1.56. So that looks like that they are getting a little bit worse because, like I said, higher is better. And Ch8and9 is pretty much staying the same, but overall, the higher number here is Starbucks. Now, another way to look at this is to say that Starbucks in the current year generated $1.56 in sales for every dollar they had in assets. So $1.56, 1.5 times basically. Okay, let's go a little further here. So is the trend up, down, or neutral? I'd say it's probably neutral for Ch8and9, and it's probably down a little bit for Starbucks. Who has better overall? Again, the better overall is the higher one, which would be Starbucks. Now let's take a look at an exercise. This is Lock Company reports net sales of $5.5 million for year 2, and looks like a little over $8 million for year 3. End of the year balances for total assets are year 1, $1.5 million, year 2, $1.8 million and change, whatever, and year 3, $1.9 million. Compute Lock's total asset turnover for years 2 and 3. So let's do that. Now, again, the formula is net sales divided by average total assets. And this is just like all these other formulas we use when we use an asset or when we use an average. We're taking the end of 1 year and the beginning of another year, add them together, divide by 2, so on and so forth. And in this situation, you know, this will give us the total asset turnover. So for year 2, we're going to use net sales of $5,524,000, and averaged assets will be $1,704,000. Now, if we're looking to compute year 2's asset turnover, then we're going to use the end of year 1 assets, which would be $1,584,000, and the end of year 2's, because the end of year 1 is the same thing as the beginning of year 2. So $1.5 million plus $1.8 million added together, divided by 2, you should get 1.704, which is looks like 1.75 million. Divide that into the net sales to get asset turnover of 3.24. Let's take a look at year 3. Sales of 8 million divided by the average asset total for, now this is for year 3. We're going to use the end of year 2 and the end of year 3. Add them together, divide by 2, 1.879. That is divided into the sales of a little over 8 million to get an asset turnover of 4.31. So things looks like they're going a little bit better from 3.24 to 4.31. So we are doing a better job of managing our assets or generating more sales from them. So now, Lock's competitor has total asset turnover 3 during year 3. Is Lock performing better or worse than its competitor? Well, if the competitor is doing 3 and we're doing 4.31 in year 3, Lock's doing better. Okay, better. Okay. Now, let's take a look at a comparative analysis of 2 real companies, Apple and Google. And we got 2 years prior, 1 year prior, and current year. We got 3 years altogether. Same thing for Google. And we've got total assets and net sales. So we already know how to do the formulas. I'm going to go in through here and show you what we've got as far as our answers and to make some comparisons. So, compute total asset turnover for the most two recent years for Apple and Google. So, here's current year, prior year for Apple. And let's take a look at Google. Google current year, prior year. Now, when you look at these two, for Apple, for example, Apple went from 0.7 to 0.66. So their looks like their total asset turnover is getting a little bit worse. Google went from 0.57 to 0.61. Looks like theirs is getting a little bit better. But still, overall, it looks like Apple is just a little bit higher. So, in the current year, which company is more efficient in generating net sales given their total assets? And it looks like for the current year, it looks like it has to be Apple. Okay. Now, does each company's total asset, let's see, does each company's asset turnover underperform or outperform the industry average, which would be 0.5? Well, if the industry average is 0.5, looks like they're both doing a little bit better than that. Okay, both. All right, let's look at the next exercise here. Same as last exercise, except we're using Samsung, Apple, and Google. And again, I'm just going to, so you can do this yourself. Well, you probably can't do this yourself, so I'll let you do it. All right, let's look at another chapter here. This would be chapter 9, and this would be the chapter on liabilities. So here's a pretty simple, hopefully simple thing to way to classify liabilities. There's two kinds basically, current liabilities and long-term liabilities. Current liabilities are things that you expect to pay off within 1 year. They're due and you pay them off within 1 year. Long-term liabilities are liabilities that are longer than a year. For example, like a 30-year mortgage. 30-year mortgage, the first year would be over here in the current liability section, and the other 29 would be over here in the long-term section. Now, again, here's an example of what I just said. These are all current liabilities. Accounts payable, notes payable, that is the portion that's due within 1 year. Salaries payable, unearned revenue, all that's current liabilities. Then we have some long-term liabilities, which would be, again, notes payable. And this would be the, let's say, years 2 through 5, 6, 7, whatever it happens to be, for this up here. Okay, this was the first year. These are all the other years. Now let's take a look at our problem here. Classifying these liabilities as to either they're going to be either current or long-term or not a liability. So looks like we'll go through, and salaries payable would be current liability, employee medical insurance payable, current liability, pension liability to be paid to employees retiring in 2 to 5 years. That's a long-term liability. Current liability for employee federal withholding. Looks like unearned revenues to be earned over the next 3 months. Well, that's less than a year, so it's going to be current liability. Prepaid insurance coverage for 6 months of coverage. That is not a liability. That's an asset. Okay. FICA, which would be Medicare taxes payable, again, a short-term liability or current. Bonus payable to be paid in 60 days. That would be a current liability. Current portion of long-term debt. Again, if the current portion means it's due within a year, so it's a current liability. Employee union dues payable. That would be current liability. All right. Now, the basic rule, this is a little bit of finance class. The basic rule when funding assets is that short-term assets are funded by short-term liabilities. And long-term assets are funded by long-term liabilities. That's a pretty simple rule. For example, you wouldn't want to put on a credit card to be paid off over a year your grocery bill. You know, some people do that, but you wouldn't want to do that because what you're doing is you're taking a short-lived asset like a food, which is going to be like 30 days, 10 days, 5, a week, whatever, and putting that on a credit card, which should be, you know, could be, in this case, if it's a long-term, well, pay off over a year, that could be like over a year. You don't want to do that. That's crazy. Okay, same with personal, don't buy groceries with a credit card. Same, what I just said. Okay, now let's look at another topic that's covered in Chapter 9, which is times interest earned. Well, it's a number that shows how many times a company could cover its interest charges with its pre-tax earnings. Now, this is something that the bank really likes to look at because they want to make sure they get paid their interest, right? So the higher this is, the better the bank likes it. Let's take a look at our situation here. And so the way you compute times interest earned is you take the net income and back out two things. It's before interest expense and income tax expense. Now, like I said, I'm going to repeat that. It's net income, bottom line net income, and then you back out of that interest and taxes, and then divide all that, whatever you get there, divide interest expense. That tells you how many times you make your interest payment. Okay, it's an indicator to tell if a company is running into financial trouble. Usually a ratio of 2 to 1. You'd like to have an interest ratio of at least 2 to be acceptable. Less than 1 indicates you are going to have a real problem and the bank's not going to like this a bit. So, the bank likes higher. Higher is better for the bank. Let's take a look at another situation here. Again, there's the formula, and let me give you a real world income statement situation. Here's our income statement. Revenues minus cost of goods sold equals gross margin minus operating expenses minus net income before interest and taxes. That's NIBIT. Net income before interest and taxes, $15,000. You want to subtract off interest expense of $5,000. You want to again subtract off taxes, and then you come up with net income, period. Now, the way to do the calculation for times interest earned, here's what we're going to do. We're going to say NIBIT, which is up here, this net income before interest and taxes. We're going to say 15,000. That's the top number, divided by the interest expense, which was 5,000. That gives us a times interest earned of 3. So that's what it looks like from an income statement point of view. That's how I do the calculation. Now let's go over here and do a couple things. Here's an company analysis from a problem that you've had in your homework. It says using the table below and Apple's financial statements in Appendix A to answer the following. Here's information from the problem. It gives you the interest expense for 15, 16, and 17. This is all for Apple. And then once you compute the interest earned, the times interest earned for each of these 3 years shown. So what you have to do is you have to come up with the income before taxes and interest from the Apple information for 2015, 16, and 17. Okay, so what you would do then is you would take this number, for example, 66,412, and you divide it by the 2017 interest expense, which is 2323, which there it is right there, and you come up with the times interest earned. So for year 2017, it's 66,412 divided by 2323, and then for year 2016, it's at 62,828 divided by 1456, and then for year 15, it's 73,248 divided by 733, and when you do all that, I'm going to give you the answer, but when you do all that, you'll come up with a times interest earned of whatever it comes out to be. All right, so let's look at another situation here. We have another comparative analysis for Apple and Google for 3 years, like 2 years ago, 1 year ago, and current year for both of them. And now we're going to compute the times interest ratio. And so I'll go ahead and do that. So the times interest earned ratio for Apple is going to be 2 years ago it was 99, now it's 43, now it's 28. For Google, it's and again I took this information right here, and these are the calculated amounts from up here. So what you can do is you can say, okay, the way I got this was for, let's say, for Apple. For Apple, I took for the current year, I took net income 48,351, added back income taxes, and also added back interest expense. Whatever that comes out to be, I then divided that by the interest expense and got 28 times, 28.59 times. So let me repeat that. I took net income, added back taxes and interest expense, and then divided it by the interest expense and got 28.59. Now let me make sure that's right, because I don't want to tell you something wrong. So on my calculator here, I'm going to take 48,351 and I'm going to add back 15,738. Also, I'm going to add back 2323 and get 66,412. I'll then divide that by the 2323 divided by 2323, and I get 28.59. So that's exactly how I did it. So in the current year and in its current year and using times interest earned, which company appears to be doing better? Well, in the current year, it looks like Google's doing way better. They've got their ability to pay off their interest on their loan is 250 times versus 28 times. So not even a contest there. And then in the current year, is the company in a good or bad position to pay interest obligations for Apple and Google, assuming industry average is 10? Well, they're both beating the pants off of 10. 10 is nothing compared to what they're doing, so they're all good. And then we have another company analysis using the table below. We've got, this is for Apple, we've got the following interest expense, and we've got this information for the net income. Add income taxes, add interest expense, come up with income before interest and taxes of 76,143 divided by that interest in 2018 by the what's going on here, 23 times interest. Okay, if you take this 76,143 and divide it by 3240, which is the interest expense, you come up with the times interest earned ratio of 23.5. Same thing with 17, same thing with 16. Sorry about that. So is Apple in a good position or bad position to pay interest obligations, assuming the industry average is 10? Well, they're doing twice as good as the average, more than twice as good. So that's good. And then we have another one here. It looks like the same times interest earned. And we'll go through here and we're going to do A, B, C, and D. We're going to take the income, add back the interest and the taxes, then divide all that by the interest expense and come up with see which A, B, C, or D is doing the best job, has the strongest ability to pay back their interest. So for A, it looks like 3.45 times. For B, it looks like 8.16 times. For C, it's 6.68. And for D, it's like 25.67. So it looks like D is absolutely, positively doing the best job here and has the strongest ability to pay their interest payment. Let's see, we have another one here, Apple, Google, current year, prior year, so on and so forth. We've got 2 years here. And compute times interest earned. So again, for Apple and Google, the times interest earned would be for current year 23.5. I'm not even going to get into all this, so you can figure this out for your own because we've done this several times now. And so here's the question: who's doing the best job? Well, it looks like much higher times interest earned numbers is for Google. And it looks like Google's numbers are getting better every year. Looks like Apple's numbers are getting worse every year in terms of their ability to pay back. But they're still good, but they're going down a little bit. So which company appears to be better able to pay their interest obligations? Well, absolutely Google does. Okay, in the current year and using times interest earned, is the company in a good or bad position to pay interest obligations for Apple and Google, assuming a 10? Well, again, 10 is not even close to 23 or 307. So they're both doing fine. That's it. Good luck. I'm signing out for now.